Oil prices have lost their gains after exporters agreed to extend historic production cuts that were agreed to in April. The Organisation of Petroleum Exporting Countries, together with its allies led by Russia, want to counter the effects of the COVID-19 pandemic, which has sapped energy demand around the world. The group is also putting stricter rules in place to ensure members stick to their commitments. The Opec Plus group has agreed to maintain a deal to slash output by a record 9.7 million barrels a day until August. The reduction was due to be eased in July. The cut represents about 10% of the world's overall supply, and oil has risen to its highest price since March. The international benchmark crude has doubled since the start of April.
The extension until July of the first phase of the adjustment agreement will help speed up the recovery of the oil market, reduce the pace of inventory feeding, and positively contribute to forming the adequate market structure.
Well, for more on this, let's go to Cornelia Meyer, Chairman and CEO of energy consultancy Meyer Resources. Welcome back to Money Talks, Cornelia. Now, the price of the international benchmark Brent hit a low of $19 a barrel in April. It's now sitting at around $40 a barrel. Do you think then the oil market still needs an almost 10 million barrel a day cut?
Yeah, I think it does, because when you look at it, we are still for the whole year, according to the International Energy Agency and OPEC, we are plus or minus 9 million barrels a day in terms of demand decline. And we had huge demand decline in April of 29 million barrels a day, which would be 30% of the January demand or also supply. So with a supply, with an inventory overhang close to 1 billion barrels, one needs to have really aggressive measures to get rid of that inventory and free up storage space.
Now, the latest developments of this deal, though, seems to be a case of giving with one hand and taking with the other, because Saudi Arabia, Kuwait and the UAE say while they've agreed to extend these cuts by a month, they're also no longer slashing their output by an extra million barrels per day as they're currently doing. What impact will that have, the fact that they're looking to stop their voluntary cuts?
I think it will have a zero impact, because what they also have said is that all the other laggards, there are about 4 countries, especially Iraq and Nigeria, who are cheating on the quota, who are really underperforming by together about 1 million barrels a day. So if you take out 1 million barrels and put that on, it will have actually zero impact. And it is fair. It is not fair for Saudi Arabia to continuously, take the brunt of all the cuts and losing market share by doing so, while others don't perform to their commitment.
Yes, let's look at that issue of enforcement. You mentioned Iraq and Nigeria are perhaps not upholding their end of the bargain. It's been a concern for many analysts. So it's almost like any deal that's agreed on is based on an honour system. How much of a problem is this issue of enforcement?
Well, I think it's less of a problem, because you might have noticed that this OPEC Plus meeting was supposed to take place on June 12th. Then it was supposed to be taken forward to June 4, and they couldn't get there precisely because they couldn't get the laggards to commit, and now they have, and it is in the communiqué that they have to make good on all the barrels they have underperformed in. And the Nigerian, Mr. Silva, the Nigerian energy minister, came out on Saturday and said he fully agreed and understood that he had to make good for the many barrels he had not delivered.
And just finally, let's look at the collateral damage from the COVID-19 pandemic. We know there's been a collapse in oil demand because of lockdowns, but we've also got companies like BP now announcing that it'll cut 10,000 people from its global workforce. Do you believe that other oil producers will follow suit and enact huge job cuts because of the pandemic?
Well, they have already followed suit, and if you look, for instance, if you look at all of the major international oil companies, the IOCs, they all have cut capex, capital expenditure, by at least minimum 25%. And when you cut investment in your future by that amount, it's just only normal that you will have to let go of some people. So yes, that is what it looks like. The people who have been most hurt, though, were the highest cost producers, especially the shale producers in the US. And the danger there, or the worry there, is that as prices recover, we might see more and more shale oil coming back on the market.
Okay, Cornelia Meyer from Meyer Resources in London, thank you as always for your analysis.